Should we have seen it coming? Debt piling up, loans repackaged into an alphabet soup of investments, sold widely to, well, game investors who bet that a AAA badge meant a sure thing. Then, a tremor in the US housing market. And the slow realisation that one knock in one place could set off a series of calamities around the world.
Most people, most intelligent, thoughtful people in positions of power in the financial authorities believed that they had things under control, that the world had become a safer place, that through a number of policy initiatives, problems of the past had been dealt with. And they weren't stupid, but they turned out to be wrong.
Financial crises weren't new in 2007. Of course not. We've been borrowing and lending, crashing and recovering for centuries. And there are common features: a build-up of debt, a sense of exuberance or invincibility, and often an innovation or a change that enables or accelerates things getting out of control. But what was unusual in 2007 was just the scale of the thing. How many things went badly wrong in how many places? The regulatory response was sprawling and ambitious. It strengthened the system, forcing banks to hold more capital. It looked at structure, stopping riskier trading in the US and ring-fencing lenders here. It massively increased supervision with stress tests and higher standards for the biggest banks. And it aimed to simplify so that banks could fail without needing a bailout. The world of finances bustled on, but regulators believe they've put the brakes on the banks. The Bank of England's governor said as much last year after the vote to leave the EU.
Those economic adjustments will be supported by a resilient UK financial system, one that the Bank of England has consistently strengthened over the course of the last 7 years. The capital requirements of our largest banks are now 10 times higher than before the financial crisis.
Through there.
The man who carried out a landmark review of the banking system for the UK government says much has improved, but he thinks reform is unfinished and that a lot more needs to be done.
I'm really very disappointed that the Bank of England does take the view that it now takes, very different from the one Mervyn King took when he was the governor, think that we've built enough in terms of capital buffers. I'd say we're roughly, global level, halfway of where we ought to be. I believe we'd be in huge trouble if a very large, very complicated banking institution got into trouble. There are tools, these so-called resolution tools, which didn't exist 10 years ago, which I think shift the odds in a slightly more favourable place. But I certainly wouldn't bet on those working perfectly.
But say the giants of banking are now stood on solid foundations. Is that enough to ward off another crisis? One of the few economists to spot the last crisis brewing sees potential for instability elsewhere.
A lot of the risks that previously existed in the banking system have migrated to other parts of the financial system, which we're not paying as much attention to as we do to the banks. So this could include, for example, the way in which insurance companies work, the way in which pension funds work, the way in which shadow financial institutions, they do banking activities, but they're not called banks. And it's here that some of the risks might lie in the event of another economic downturn, or if there's an external shock when people suddenly go to ground and they want their money back.
The crisis changed society: economic slump, stagnant wages, mistrust of elites. But to this former regulator, the financial system looks broadly similar. The philosophical building blocks haven't really changed.
We had a view that the right thing was central banks acting through monetary policy to keep inflation under control, regulators, mostly separate, acting on individual institutions, a belief that efficient markets worked and could be relied on, that the bank's own internal risk management, based on mathematical analysis, would give the right answers. Now, all those are things which we have to think about more deeply, and we haven't done the creative work yet, a decade after the acute crisis.
Back where it all began, the US housing market was at the epicenter of the crash, and yet there's growing clamour to row back on post-crisis regulation, or what's known as Dodd-Frank, the 850-page financial rulebook passed in 2010.
We're doing a major elimination of the horrendous Dodd-Frank regulations, keeping some, obviously, but getting rid of many.
Much more aggressive intervention is needed.
This veteran of US bank supervision is worried. In the crisis, she helped clear up hundreds of US bank failures.
It's short-sighted. It may be politically expedient. Ironically, I don't think it's going to help the economy. I think if you loosen up on bank capital standards in particular, what's going to happen is you're going to increase shareholder payouts, dividends, and buybacks. So it could make the system less resilient, more unstable, really won't help the economy. It will benefit private shareholders, and that's not a good reason to do it.
Despite concerns, there is general agreement that the system's in better shape than a decade ago. But there are always risks. Could a big bank fail without setting off a destructive chain reaction? We just don't know. Have we inadvertently created new dangers in how we reacted to the last crisis? That's possible, even likely. And are the scars of the crisis still fresh enough to stop us making similar mistakes again?
I think there is a lot of truth in the argument that it is a generational thing, that once the crisis passes and, people get used to the idea of doing innovative things in finance again, which are usually the same things that their parents and their grandparents did, the products change, the names change, but actually it's about greed and about, credit. It is a regular phenomenon, which I think we have to try to control somehow.